Hello, everyone. We're just about to start. Okay, we have Joseph on with us. Neelam and Atul are also here. Perfect. Go. Right. There is a rather popular saying that goes, Rome wasn't built in a day. And I don't think anyone disputes that. But did you know what ended the great Roman civilization? Historians believe it was the runaway inflation that was the major cause of ancient Rome's fall. If we look at the statistics of that period, it shows that between 200 to 280 AD, the cost of a bale of wheat rose from 16 to 120,000 drachmas. It has been labeled public enemy number one and may very well be one of the most familiar words in economics. Inflation has plunged countries into long periods of instability, has helped politicians win elections with promises that they will tame inflation, and has caused them to lose just as quickly when they have failed to do so. Hello, everyone. Thank you for joining us for today's webinar, where we take a closer look at inflation and try to answer the question, can it be tamed? Before I introduce our guests, a bit of housekeeping. This webinar is due to last about 60 minutes. If for any reason you get disconnected or logged out, you can use the same link emailed to you to rejoin. We have this available as a recording, and it will be available on our social channels as well. We will have time for question and answers from our audience members, so do definitely type in and submit your questions in the Q&A box, which should be available on the bottom part of your screen. With that, kindly allow me to introduce our guest speakers for today. We have with us Mr. Atul Penkar, Senior Fund Manager with Aditya Birla Sun Life AMC. Atul manages equity investments at Aditya Birla Sun Life's AMC's international business. With over 17 years of experience in equity research and fund management, Atul is currently responsible for managing India-dedicated funds. He has been with Aditya Birla Sun Life AMC since 2006, where he started as a senior analyst and portfolio manager. Atul was responsible for having multiple onshore thematic and diversified equity strategies before he moved to the international investments desk. His equity research expertise in Indian markets is across information technology, infrastructure, telecom, auto, and media. Atul holds a bachelor's degree in engineering and a master's in management studies. Welcome, Atul, to today's webinar.
Hi, good evening.
Good evening.
Thanks.
Also with us today, we have Mr. Joseph Graham, who is the Managing Director, Investment Strategist for Lord Abbett. Joseph leads the efforts of Lord Abbott's investment strategist team. This team serves as the client-facing extension of Lord Abbott's investment team, communicating with institutional clients and prospects regarding asset allocation topics, market environment, current portfolio positioning, and the firm's market outlook. Joseph currently has a focus on high-grade and multi-sector fixed income, including convertibles, but also has an extensive background in quantitative tools and equity portfolio management. Joseph joined Lord Abbett in 2015. Prior to joining the firm, he was a founder and CIO of two quantitative hedge funds, Hudson View Capital Management and Route 3 Capital. He has been in the financial services industry since 1999 and has earned a BS in Finance and Philosophy summa cum laude from Washington University and an MBA with honors from the Wharton School of Business at the University of Pennsylvania. He is also a chartered financial analyst by designation. So welcome, Joseph, to today's webinar.
Thank you. Nice to be here.
And also with us today is our very own Ms. Neelam Verma, who is the Vice President and Head of Investments for the Continental Group. Neelam is a seasoned finance and banking professional with over 20 years of experience across investments, private banking, and wealth management, corporate and commercial banking, real estate finance, retail banking, and Islamic banking across India and the UAE. She holds an MBA Finance from New Hampshire University in the US, is an advanced strategic management expert from IIM Ahmedabad, and holds a mini MBA from Harvard Business School. She is also a certified wealth manager from the American Academy of Financial Management and an ICWM from CISI UK. Welcome, Neelam, to the webinar.
Thank you, Anson. Hello, everyone.
My name is Anselm Mendes. I am the Executive Director Sales at Continental, and it is my pleasure to be your host and moderator for today's webinar. Right, first things first, we would like to hear from you, our audience, your thoughts on the question that is going to come up on your screen. So it's the first of our poll questions. You will find these questions come up from time to time. And it's a very straightforward, simple way for you to be able to answer those questions. Click on and select one of the options that are visible on your screen as soon as the poll question comes up. So the team should be putting up the poll question soon. There it is. It's on your screen. The first poll question: in the current market situation, where would you like to invest? So what's your preference or your preferred choice of investment? Is it A, equity or the stock markets, fixed income, C, gold, or D, cash? So do fill in your response and submit that answer. You have to press the submit button so that we get a chance to have a look at the responses that are coming in from you. Neelam, let's start with you while we are getting the responses from the audience. And what would be nice is if you could take us through how the rising interest rate and higher inflation is affecting the global economy. What are you seeing?
Well, it's a question that is on everyone's lips now. What is happening? What's happening around inflation? Are we looking at a recession? Let's start with something which is a little positive. Volatility definitely is rattling the markets. There are concerns about inflation, interest rates going higher, and impacting the economic growth worldwide. But on a positive note, there are also early signs of potential investment opportunities that we see in the near future. Concerns about high inflation have dominated for some time, and these concerns actually increased further with the mindset becoming more dominant. And typically we see that inflation comes in, the actual inflation comes in when people start expecting inflation. While it's becoming increasingly difficult to curb high inflation, a recession definitely is required to depress this kind of figure of about 8.6, 8.7 to around 2%. Now that's a long journey. However, given the high debt levels, we expect possibly the recession could easily turn into another credit crunch. But as we saw in 2008, at that time, the fiscal and the monetary reserves that were required to combat such a crunch now seem to be exhausted. So while it's difficult and it's doubtful to see whether there could be a possible crunch, there are central banks which are now scratching their heads and trying to see how do they put an end to this situation. Talking about the US, it has been on the central bank's tip for years. Anything and everything that has happened after 2008, 2009 credit crisis, a lot of money, vast amounts of surplus kept the economy growing. And in particular, the asset markets, whether it's the equity market, the real estate, or for that matter, even crypto, it soared to exceedingly high levels. Now for the Fed, it had that dual mandate of keeping the inflation in check and at the same time look at maintaining employment levels. Now the party was going, but the party was going because there was a structural downward force on the inflation. We didn't see inflation number high. But with the COVID situation, the supply side problems, which were actually caused by the Ukraine war much recently, threw everything out of the window. And it was not possible anymore to hold on the inflation low and keep pumping in dollars into the economy. Now, everyone has been indicating, whether it's the Fed or ECB, that they want to avoid a recession. And it's understandable because there are massive debt piles that they carry. Now, all this can be looked at from both developments on the supply side of the economy as well as the demand side of the economy. Now, supply side may recover but very slowly. That's because there's huge amount of sanctions that are placed against Russia. I think Corona, the postponed healthcare and shortages in the hospital. We see still China reeling under pressure with the COVID situation, and to some extent aging population, which are keeping a tight hold on the labor market. So a lot of times we think that there could be a soft landing that the central banks would look at. And but again, when we're looking at soft landing, the results are likely to be slow. And I don't think any of the economists are willing to look at that slow movement. Now, the problem or the critical part is the central banks have to choose essentially between excessively high inflation or inducing a recession. A recession on the onset would also, I assume, central banks should hit the monetary gas pedal as soon as they see recession hit, and recession technically is 2 quarters of negative growth. What does it mean for the stock markets and the bond markets? It means that a greater part of the decline has already happened. And we can look at a new rally that can come in, and it's not too far away. However, a far greater decline, if I can see what the markets are doing, a greater decline could also prove to be risky from the perspective of central banks, because a lot of assets do serve as collateral for the loans taken on. On the other hand, the demand side just keeps changing. There's huge amount of pent-up demand, which we see coming in, and that is what is the cause of the high inflation numbers. Just to close, we saw US CPI inflation number at all-time high at 8.6 recently. The expectation was at about 8.4. Now, which means that the price increase is spreading faster across goods and services, which means that it becomes more imperative for central banks to act and curb inflation. So just talking about inflation cracking down would be the first priority for the time being. And the policymakers have to do a lot more. As of now, they're doing far too little to make the economy more resilient and productive. So that's my take on how inflation is denting the economies and what interest rates could do or harm going forward.
Sure. That was a very comprehensive answer. Thank you for that. I think it's good to be able to set the tone and set the pace for the discussion that we're about to have. I think before we get into the next one, I'd like to have a look at the poll results and see what our audience is thinking. Do we have the poll results? Can we have them up on screen, please? There we go. So the question was, in the current market situation, where would you like to invest? And 68% of our audience is in favor of the equity or the stock market, 21% in fixed income, and 5% in gold, and we have 5% that would still hold cash. So very interesting, I think, responses from our audience there. And going by that response, and I'm sort of getting into the next question. One of the scariest things that I do nowadays seems to be visiting a petrol pump. And Atul, I'm going to bring you on in here to sort of help us understand the role higher energy prices and the supply chain challenges sort of play in rising inflation.
Yeah, so, globally, most of the countries are struggling with higher energy prices. And if you look at it, first to look at, how energy prices has direct and indirect impact on our lives. So, direct impact reflects in, as you said, in terms of higher domestic fuel prices. So as a consumer, we pay higher prices for auto fuels. The indirect impact of rising fuel prices is on transportation cost. So which impacts the cost of goods like vegetables, cement, and steel, etc. So as prices across the board starts to rise, eventually it kind of reflects in higher wages as well. I mean, there is a lag impact which it has on the wages. Now, if you look at from supply chain, even supply chain disruptions has a similar impact on inflation. For instance, a couple of when COVID broke out, immediately after COVID, due to massive US fiscal stimulus, the demand for goods surged. And since this happened during lockdown, it resulted in consumption pattern more in favor of goods over services because of the lockdown being in force. And this happened when the entire supply chain was disrupted. So what it really did is it really kind of created artificial shortages and longer delivery times. And typically, in this kind of scenario, the buyers, their thought process shifts from just-in-time principle, which has been practiced over the last many years, to just-in-case. So therefore, buyers started to hold on to inventories. So this was one effect that we saw because of disruption to supply chain. Now, if you look at the second event, and Neelam briefly spoke about that, the recent event, Russia-Ukraine conflict, and the associated sanctions, which have kind of reduced the global supply of food and energy, and therefore, the fiscal and monetary measures cannot address the shortages issue of food and energy. And to add to that, the China's no COVID, zero COVID tolerance policy also has prevented the full normalization of supply chain. So thus, if you look at all these factors together, it's kind of preventing the prices to mean revert to pre-COVID levels. And that's kind of impacting inflation. So net, if you look at both higher energy prices as well as the supply chain disruption, there is a cascading impact on inflation, and that's kind of leading to eventually slow down in demand and growth. When you try to look that and put in framework, say from India's perspective, and look at the composition of inflation, which is CPI, which has been looked at. 76% of CPI basket in India is constituted by goods, while the balance 24% is by services. And as you know, services are less prone to supply side disruptions as compared to goods. So as a result, supply chain supply side disruptions have impacted goods supply, and that has kind of created a higher inflation in this period. Obviously, as things normalize, the inflation is expected to cool off, and as the mobility increases, even the disruptions to supply side also eases. So in the meantime, we have to live with higher inflation for some time, till the time we see energy prices cool off, because as demand cools off, eventually that reflects in a lower demand for energy, and because of demand supply balance, you will see that inflation also eventually comes down.
Yeah, thank you for that, and let's hope so that happens quickly. Let's shift tracks a little bit over here and look at the fixed income space. And Joseph, let's bring you in as well. And the question I have for you is, how would you say fixed income assets have performed historically, especially in the situation that we are seeing today, where interest rates are rising and there's a higher amount of inflation?
Yeah.
What can the past teach us?
Yeah. So thank you. And it's a good question. I guess you first need to realize, like, fixed income risk is really two big things. It's rates and it's credit. Mm-hmm. Most fixed income portfolios, if you think of like a core type of portfolio in fixed income, are very heavy rate risk. So it's sovereign debt, it's mortgages. Those are just big parts of the fixed income market. With the amount of volatility, interest rate volatility that we've had, interest rate risk is the dominant risk in most fixed income portfolios. So inflation and rising rates are almost by definition terrible for that. Rates up and prices down. However, one thing you should realize, and I think most people do realize this, the markets are a discounting mechanism, right? So just to say inflation is coming or higher rates are coming, well, the 2-year, 5-year, 10-year points on the curve already discount a lot of rate hikes from all these central banks and in Fed included. So that's one thing to understand. What we're really talking about are higher rates than currently expected, or higher inflation than currently expected, how does that impact the fixed income market? And again, on the rate side, terribly. The credit side, however, it's a little murkier. So normally when rates go up, that's indicative of a strong economy. Companies are able to repay their credits.
Yeah.
And so it's not surprising that in most instances where rates go up, credit does pretty well. Looking through that a little bit more to when inflation goes up, we don't have a lot of data on that, because the last time we really had an inflation problem in developed economies was, the late 70s, when there wasn't a very well-developed high yield market, for example. There was, but it was fallen angels mainly. They weren't issued as high yield. So in the late 70s, credit did very well, actually, but it started from a pretty low base. Now, there's some intuitive reasoning to why credit would do well. And that is that you're inflating your way out of nominal debt. You have a debt that's in a certain dollar amount. If you have any kind of pricing power, you're growing along with inflation, and you can inflate your way out of that debt. It's kind of taking a page out of central bank playbooks. So we think credit can do well. And so far it hasn't, during this period, but we don't think this period is over. One final part of this question, and I'll be quick here, is during rate hikes. So this is a little bit separate question, right? It's not about rates overall and not about inflation, but actually rate hikes. Like what happens to fixed income then? And what we've seen, at least in the US, is the last 5 times we've had rate hikes, the curve has flattened. The 210 curve is flattened. So it's almost every time, it's 5 out of 6. And the 6th one was minor. Interestingly, though, you're actually still better off in the short end, because you don't have, you're repricing quicker and you don't have as much interest rate exposure. The last point I'll make is I think it might be different this time. And the reason I think it's different this time is we're already so flat. The 210's inverted right now. It was about 20 basis points of spread coming into rate hikes. So one, we've never started this flat. The other is we have a $9 trillion balance sheet to unwind in the US. And that comes out of the middle. So on the margin, that's a steepening effect as you start to unwind that. So we think it may actually steepen this time.
That's very interesting. So going forward, there is a possibility, like you're mentioning, of us seeing more on that side. And I think, of course, we will find out soon. But in the meantime, thank you again for going beyond and giving us a little better perspective as well on both the interest as well as the credit side of things. We are going to go to a poll question before we move on to the next question. And the poll question this time around is going to be up on your screen, and it reads, what is the biggest threat to global economic growth this year? And you've got options: higher inflation, rising prices of crude, global uncertainty, rising COVID cases. So while you answer those questions and while we wait for the results, do remember that if you have a question that you'd like to ask and ask our panel, please enter it in the question answer box and hit submit. Don't forget to hit submit. It's important if you want to get the question across to us. We'll try and get to all of the questions that we can. For those questions that we are unable to get to during the program, during the webinar, we will respond to you by email with a response. All right, we should have our results soon, but here's a question to all 3 of our panelists. And we're going a little broad here. So if we look at it, how do you see the soaring commodity prices and interest rates affecting the finances of different countries? So if we could look at the different economies, different countries, and sort of give our take on how we see those the impacts there. And we'll start with you, Atul, if you'd like to go ahead and give us your perspective on that.
Sure. So if you look at from macro standpoint, higher commodity prices are net negative for commodity importing countries, obviously, because of the number of dollars that you require to fulfill your requirement goes up. Similarly, higher interest rates are negative for the investment and the consumption environment of a country. So broadly, countries with higher debt to GDP ratio and mostly financed by external commercial borrowings are most susceptible to interest rate shocks and rising current account deficit. So having put that macro backdrop, let's look at the current situation from India's perspective. So to ease inflationary pressure in the economy, besides monetary policy, which is like increasing interest rates in the country, the government has intervened through fiscal measures. I mean, they have reduced the duty on petrol and diesel, and the kind of effectively leads to revenue loss in case where there is a tax cut, or there is an increase in expenditure because the government has increased the subsidies which they are providing on food and fuel. So that kind of leads to an increase in fiscal deficit as well as current account deficit for the country. So that's the macro impact. Secondly, is as interest rates are raised, higher rates impact the interest payment on debt. And over a period of time, as borrowing increases, interest payments keep increasing, which reduces the space for productive spending. From government's point of view, when you have a budgetary allocation, it's between revenue expenditure versus capital expenditure. That's the kind of allocation which a typical country will do. And we all know that capital expenditure is more productive nature of spending in any economy. So that is kind of because of constraint, because of higher current account deficit and fiscal deficit, that kind of brings a constraint on a country's ability to spend on capital expenditure. And to summarize, if you look at any country, that I think the typical ratio to look at is what is the sustainability of debt. And that has been looked at when you look at what's the difference between the rate and the nominal GDP. When you look at India's debt situation, and we believe that the sustainable India's debt situation currently is sustainable because the interest rates currently versus the nominal GDP growth, there is a huge difference. So I think as long as the country is able to grow, currently with about 6.5% kind of real GDP growth and about 7% kind of inflation, we are about 13%, 14% kind of nominal GDP growth. So as long as you are able to grow, that debt is sustainable. So I think from that point of view, India's macro is stable because of the higher growth and the kind of foreign exchange reserves, almost $600 billion, which the country has.
Sure. Thanks for that. Thanks for that, Atul, and thanks for summarizing as well. Joseph?
Still on mute. So from a US perspective, this is a little bit different than it was, say, the last time we battled inflation. It was similar in that it does affect oil and gas, energy costs, food costs, to a lesser extent in the 70s, more today. But what's different now is that those are a much smaller share of consumers' wallets in the US. And because, unfortunately, of income skew, that portion of the population that is affected by higher energy prices is a very small part of consumer spending in the US. So not only is it smaller as a portion of their budget, those consumers that it affects a lot are a pretty small portion of overall spending. So add that with how much savings there is because of all the government giveaways that we had during the pandemic, and you're actually in still a pretty good situation for the consumer, we think. Now, the sentiment surveys and things that have come out have said the opposite, and those somewhat diverge between some of the surveys. But we actually think the consumer can get through this okay in a modest recession and an inflationary environment.
All right. Thank you for that. And Neelam, I'm going to bring you in for the same question, but also one is from a perspective of if you can speak a little more specifically into maybe, and go into sectors and countries that you think would also be good investment or good for investment during these kind of scenarios as well. So if you could address both of those.
Sure. Actually, first, I want to go to the poll question and say all of them are a threat. So all the answers should have been all of the above, because inflation creates a different sentiment in the market, and sentiments is what drives every one of us. So yes, that's one of the things that I thought I should mention. Atul mentioned about the India situation, and Joe mentioned about the US situation. I want to touch base a bit about what's happening in the world that we live, which is GCC. Of course, because of oil production, we feel that there's going to be huge surpluses that the countries are going to accumulate, and that has happened in the past. So learning from the past, we've seen that there's huge amount of capital expenditure, and I think the growth in the economy has come in by way of the government spending, which in turn leads to a lot of employment opportunities, and that sends a lot of positive signals to us in the local markets. High oil prices are definitely good, but we need to also understand that we are economies which do not have enough production. We're importing economies, and that is where the challenge lies. I think the majority of the food items are imported. We at UAE in particular, because of the peg of the US dollar, are in some way importing inflation through that route. So there is a delicate balance that we need to maintain, and commodities driving up the way they have, I think is not going to be a good scenario, because the savings are going to be impacted. Interest rate increase is impacting the savings. So yes, there's a lot of confusion. The second question is which sector? I think given the recent market moves, it's absolutely safe to assume that we've seen most of the investment portfolios go through a decline beginning of this year to some extent. The extent of declines and volatility are largely dependent on how the portfolios have been allocated across various asset classes and what kind of exposures the portfolios have to different demographies and business sectors. But we've not seen much of change in the fundamentals as yet. The interest rate hikes are just sinking in. We might see corporate earnings in fact get affected possibly next year. So in terms of sectors, I think we should look at adding allocation to consumer staples, discretionary. Healthcare remains one of the favorites, of course, technology, and to a large extent, energy. Now, energy could be looked at in both direct and renewable forms. We're also looking at financials in a big way to participate and have certain allocations too. I think the approach should continue to be bottom up, and we should be looking at the companies and their business plans rather than just picking up a sector.
Absolutely.
So this becomes a lot more relevant when we're looking at holding direct equities. When we're looking at funds, of course, a lot of other factors come to play. I think I need to also address one more thing, which is the concern that we hear from investors in such a market scenario, and the resistance in taking an action right now. I think the discussion is now getting surrounded from, are we looking at a loss, or can we look at something which can downsize or reduce the negative returns on the portfolio from the current levels? So that's the shift I've seen in the investor sentiment over the last 3 to 6 months, wherein we were looking at continuous growth. I think we've seen one of the biggest bull markets or bull runs over the last 2 years or so, and a bigger one since 2009. So if we are talking from that standpoint, I think all these sectors look very attractive. Markets, like everyone has been talking, have been up for sale for some time, and these opportunities, like I started the conversation with, are very much visible now.
Thanks for that, Neelam. I'm going to go back to Joseph. Joseph, there's something that you mentioned in your previous point that sort of slipped by and suddenly hit me back again. So you did mention that we're probably going to see a recession, and we are seeing a lot of warning signs with regard to, or signals with regard to, either the government's trying to trigger a recession, or we're going to get into a recession. Not just in the US, but also in some other parts of the world. So if you could elaborate a little on that, what are your views on that?
Sure. Yeah. First of all, I don't believe yield curves are good indicators of recessionary probabilities anymore. They may have been at one time. Now there's a flattening bias, a technical bias in yield curves because of central bank buying, a savings glut, the popularity of LDI investing liability matching in pension funds, which just flattens the curve, which makes it overpredict recessions. So that's one point. It's not because the 210 is inverted that I think we are in a recession. I think we're in a recession because we put up a negative GDP print in Q1 in the US, and we're likely to put up a negative one in Q2, judging by the Atlanta Fed's GDP Now estimate and a bunch of other indicators. So all that said, I think it's likely to be a pretty technical and modest recession. And it's almost like a victimless crime in some sense, because what you really fear with a recession is losing a bunch of jobs and defaults on the credit side. That's what we fear.
Absolutely.
I actually don't think either of those things will be too severe. One, just because we have so many job openings in the US right now, it's going to take a long time to work through them. We have a lot of mismatches in the US where we think some industries will thrive, some industries will continue to be strapped. And overall, we don't think joblessness goes up much above, 5% or, some relatively modest level. The other part is credit, which I've talked a little bit about already, but balance sheets are in tremendous shape. And that's what is unusual about this cycle. So normally you have like this cycle of boom bust where you start to build up a lot of debt and things get over levered, and then the dominoes start to fall, and then you retrench into a recession and you have defaults and things like that. This wasn't that kind of cycle. We never saw the craziness in terms of borrowing that you normally see. And so you actually have balance sheets in great shape. I think Neelam mentioned margins are in good shape. However, they are likely to weaken, but we think not enough that you'll see a super cycle in terms of default, at least in the US. So, and also add to that, each default cycle we've had in the US since 1980 has been shallower than the last one. And I think part of that is just the central bank's willingness to step in, fiscal spending willingness to step in. Like in a way, we're becoming a little more like Europe, more like Japan, which have lower default experiences. So we're still optimistic, even though I think we're probably in a recession.
Sure. Oh, good to hear, and good to know. Hopefully it is a shallow one and we get out of it quickly. We have the results of the poll that have been ready for a while, and I think let's have a look at them before we go to Atul. All right, it seems like the responses are, okay, clearly higher inflation seems to be perceived as the biggest threat with 41% of the audience. But I think, Neelam, what you predicted was somewhat accurate in the sense that we're seeing very close 30% for both rising prices of crude as well as global uncertainty as being perceived as the biggest threats to the global economic growth in this year. All right. Atul, I'm just going to sort of come to you for a little bit, digging into an area of expertise that you have in terms of the equity markets. And how do you see them reacting in the current market situation? So how do you see equities, and what will be likely consequences if we enter a recessionary sort of period?
Right. So, equity markets generally perform well in early days of rising inflation, just like they did in the current cycle. So it's more of, the central bankers remain in denial mode, and the growth is chugging along quite well. So market tends to do well. However, when fears of inflation gets broad-based and expectation of recession fears kicks in, equity market tends to correct. And typically what we have seen is equity markets are slightly ahead of time, and it kind of preempts and adjusts the risk ahead of the event on both sides when things are about to get worse. So market sense the kind of threat, and then it corrects in before that actual the event unfolds. And the reverse is also true when market starts to build in the negatives, and then looking at valuations, looking at the strength of the economy, and and likely comparison versus how things have shaped up across companies, across various sectors. One looks at whether the valuations have bottomed out and whether it kind of factors in the worst. And as things improve, what could be the upside? So that's when market tries to build in and then starts to look up. But I think what really matters for market is during this entire process is how is the cost of capital going to change depending on how elongated this period is. The second is in terms of to what extent is the demand destruction which is likely to happen, right? Because when you're talking about a recession, whether it's a quick or elongated or deep recession, it kind of leads to demand destruction. Second, I think most important is how is the health of corporate balance sheet. And clearly in the last couple of years, what we have seen is because of the strong growth, most of the corporates across sectors have very quite healthy balance sheet. Even the consumers, their balance sheet positioning is very, very strong. And lastly, in terms of the expectation of growth post the tightening cycle. We will see that front-ending of interest rate hikes happens, and that leads to demand slowdown and slowdown in growth. And post that, one tries to gauge as to over what period of time the growth will pick up. So, in a nutshell, higher for longer inflation typically hurts the demand, both through inflation as well as higher borrowing costs. And there is a lack of visibility of how the monetary cycles may get and drive the equity markets lower during these periods. And typically this is a quite painful process, particularly for growth-oriented stocks, and that's what we saw, that the tech stocks actually corrected much sharper ahead of the actual increase in interest rates. And typically what we see is investors shift from those growth-oriented high valuation companies to defensive strategy and buying into the value-oriented stocks.
Sure. All right, thank you so much for that. I think we're sort of coming close to the time for question and answers from the audience. We've got another poll question, and I will go to the final question to the panel after we've got the poll question on screen. By what percentage do you currently see rising inflation impacting your cost of living? So question to the audience, the answers being A, 10%, B, 20%, more than 20%, or no impact of rising inflation on your cost of living. So do submit your answers. In the meantime, I am going to go to our panel with the question that we have for all three panelists, and this is something that is more a quick take and a summary of our position. So if we can get a quick round from each of our panelists with regard to, so we've given that there is a rise in oil prices, and whichever and whatever the factors are, and if we look at it from a perspective of, and I know this is going to put a big smile on Elon Musk's face, but if you look at it from a perspective of more countries adopting sustainable energy, what are your thoughts? What are your views? How likely are we to see this happening? Joseph, I'll go to you first, and then to Atul, and then to Neelam.
Sure. I think eventually, this has to happen, and it will happen because it's sort of the will of the people for it to happen. However, I think the supply side of the sustainability and ESG movement is way ahead of the demand side. And that's going to lead to continued high inflation. And that is that companies, at least in the US, and I think largely around the world, are self-restricting themselves from capital expenditures and from taking things out of the ground because their shareholders don't want them to. They want them to return capital, to have a plan to transition. So it's an amazing situation where we need investment in this area in order to meet the demand that's there, but companies refuse to do it because they have other incentives. So we think that is going to be a long-term driver of continued inflation, unfortunately.
All right. Thank you for that. Atul, your quick thoughts, please.
I think adaptation and investment in sustainable energy has gained prominence in the last few years, and we believe that it's a irreversible process. But I will. It's a slightly slower process that we have seen, and just like the way technology and digital adoption happened during COVID period because of the circumstances back then, I think the current situation where the energy prices are at an elevated level, it's time that sustainable energy investment kind of picks up materially from here. But there are some practical roadblocks to significantly ramp up sustainable energy capacity in the short to medium term. And in the meantime, the traditional energy sources will continue to dominate the overall energy baskets.
All right. Thank you for that, Atul. Neelam?
I think both the gentlemen have spoken a lot about this. I completely echo their sentiments. Sustainable energy is something that we've been talking about for the last almost a decade now. However, the uptick in the entire industry has been pretty slow. The reason being there were record levels of oil prices, and we all know that we were very happy with those prices. The kind of consensus readings that I'm seeing, there is a huge disparity wherein some analysts looking at $60 a barrel of oil to about $390, depending again on how the Russian-Ukrainian conflict pans out, what happens to the G7 leadership deciding in terms of putting a price cap on the Russian oil, the European insurance company crisis. There's so many factors. While these factors might be short-term, investing into sustainable energy is going to be long-term. And as they both said, it's not that easy a process. So it's going to take up some time. Of course, climate change has another side of the story. We'll not touch base on that. So I think we all will eventually migrate. But yeah, it's going to take a longer time than what we thought it would, unlike the tech sector.
All right. Thank you for that, Neelam. We've got the responses to our poll. So let's have a look at what the audience is thinking. If we can have the results on screen, there you go. So that's 38% expect that impact to be more than 20%, followed by 29% seeing that impact on the cost of living at about 10%, and 33% seeing it at about 20%. So somewhat of a sort of split vote in that sense, with maybe a larger portion, somewhat larger portion seeing a more than 20% impact. All right. With that, we've got quite a few questions that have come in from our audience, and we'd like to get to that. So if you've not submitted your questions, you still have time. You can still type in your questions in the Q&A box, and we'll get to as many of them as we can. First question, if we can have the, I think there's a poll before that. There's one more final poll question, and if we can have that on screen and go to the first question from the audience, please. Okay, it should be coming up on your screen just about now. Or we could go directly to the audience question if that is not working. So if for some reason it's stuck. Yeah, there you go. So we can come to the poll question when it's ready. But the question on screen is why are countries after countries falling in the financial crunch? What would you ascribe it to? I think we'll blame it on bad management or external factors. We can take this to our panelist. Neelam, would you like to guess an answer on that?
It's a very strange question. Yes, countries keep falling up, after you see high interest rates. As we spoke earlier, that if you have high imports coming in, high interest rates coming in, It's a double whammy on a lot of countries. So I don't say that it is going to be bad management, but yes, a lot of the coffers that the government wants to use to grow the economy, spend on the sectors which it feels would be important for the growth of the economy, actually gets sidelined. So they keep falling into that bad management practice. I don't see it as bad management, but they try to make sure that they're able to manage the situation and thereafter try and come back on track. I don't think it's bad management at all.
All right. I hope that that answers the question. Let's go to the next question from the audience. And these are going to be up on screen. Okay, I think this was the same question. If we can go to the next one, please. Okay, this one is on emerging economies. Do you think emerging economies will perform better than developed economies? If you talk about India, the MFG PMI is above 53 and services PMI is about 57. Still, do we think we are heading towards a recession? Atul, I think this one is for you. Would you like to respond to that?
Yeah, I think, from India's perspective, when you look at from top down, there's clear macroeconomic stability that we are looking at. The current situation has kind of had some hiccup in terms of higher inflation and resulting into higher interest rates for some time. But if you look at the underlying growth in the economy, so last year, India's GDP growth was 7.5%. For this financial year, India's GDP growth will be 6.5% to 7%, and that's a very healthy kind of growth to have in current situation. So even if you look at from the corporate India perspective, the demand is quite good. If you look at in terms of the earnings growth expectations from corporate area, that's expected to be about 13% to 14%. Obviously, it's anybody's guess as to how higher inflation and interest rate will impact the demand, which is likely to be in second half of this financial year. But even if we shave off 100 to 200 basis point from that earnings growth expectation, we are still looking at about healthy 11 to 12% kind of earnings growth in the kind of worst economic environment. That's a very good sign. Also, when you look at the headline valuations of Indian markets, it's trading at slightly below the long period average P multiple and PE price to book multiple. So valuations are now attractive. And one of the concerns with investors had was on relatively higher and expensive valuations of Indian equity markets. So now the growth outlook is positive. Your valuations are below long period average. And the growth is likely to sustain for the next 2 to 3 years because of the underlying resilience of Indian economy and earnings growth visibility that we have for corporate India. So I think it's a best time to kind of increase exposure to Indian equities.
Excellent. Thank you for that. And I hope that answers the gentleman's question. We have a couple of more questions to go. And yep, I think more questions still coming in. So to have the next question on screen, please. All right. Is the increasing interest rate, or are the increasing interest rate, or does the increasing interest rate mean the best buys are banking and finance funds? Or do you feel banks will suffer because people stop borrowing and stay away from loans? All right. Joseph, would you like to take this one?
Sure. You noticed I unmuted myself on this one because I wanted to take it. Yeah. So I've previously made the argument that we could see a steepening in the yield curve. And that's partly the impounding of inflation uncertainty into bond pricing, which causes yield curves to steepen. But also something I haven't talked about, which is the flipping of correlation between stocks and bonds. That's been a major shift in the last couple of months. And that has huge implications for asset allocation. It means that bonds are less valuable in a portfolio, rate-oriented bonds, not talking about credit here, are less valuable in a portfolio because they don't diversify your stocks anymore. And they often don't in an inflationary environment. So that's another reason why we think the yield curve likely steepens. And getting to this question, that's good for finance companies because the steep yield curve is usually a good driver of borrow short, lend long. It could be that there isn't a lot of loan demand. That's true, but I think that is likely over the long term. There will be some loan demand. Like right now in the U.S., you look at like mortgage rates relative to the 10-year, which is a common kind of spread that people look at, and it's very large. And so that's very profitable for banks. So we do like banks. The other thing that's happened to banks is regulators often fight the last war. And the last war was 2008, 2009, which was banking crisis, of course. And so banks are very regulated. So in the US for sure. But people still think of them as, taking a lot of risk and doing the crazy things they were doing in, the pre-2008 era. So we actually think from a debt holder's perspective, these are great companies to invest in, and it's underappreciated by the market.
Yep. Thank you for that. And yep, I agree. We've got, I think, 2 more questions and 4 more minutes, I think, which should be good for us to be able to cover those. I think, yep, there we go, coming up on screen. Oh, okay, this is an interesting one, and I think we'll go to all 3 of our panelists on this. Where would you invest your money during the current times? Let's bring Neelam in. Neelam, we'll start with you, and then we can go to Atul and Joseph.
Well, I've been talking about equities, and I'm going to say equities it is. I think everyone will echo the same sentiment. The valuations are attractive. We've seen double-digit growths over the last so many months. While you won't see the same growths, you won't even see these prices available. We've invested at highs. We've not invested at these prices, which are extremely attractive, be it banks like we spoke about, be it consumer, be it energy, or even the sustainable energy stocks, the EV stocks like the Teslas or the NIOs of the world. The second thing I think we should be highlighting here is emerging markets look attractive. So emerging markets is the place to be. India is the place to be. China could be the place for investors. Looking at the local markets, I think UAE markets look very attractive. So these are the 3 areas that I would look at, particularly in the equity space.
All right. Thank you for that, Neelam. And we go to Atul next. Atul?
Yeah, equities for sure, because, valuations are attractive. I think the worst is behind us in terms of inflation, and that is getting reflected in the valuations. And, if you look at historically, if one has to beat inflation, equities as an asset class has successfully managed to deliver returns to be able to better than inflation. So I think from that standpoint, from medium to long-term perspective, it makes sense to invest when all the chips are down and you get good bargain deals in equity markets.
Thank you for that. And Joseph?
I agree on equities. And I'll add, even momentum-oriented type of equities, I think in a time like this where people are concerned about pricing power and it's uncertain, who has pricing power, momentum can be a nice indicator of who's winning in the environment. And if you look at momentum, they've done well this year, long short at least, momentum has. And on the long side, it's been defensive because momentum's been terrible. And so it's a lot of those funds have stayed out of taking a lot of risk. On the credit side, I do like credit, as I've said a number of times, and I think shorter duration type credit is also applicable if you have that steepening yield curve. And one other thing I'd say is multi-sector is another kind of idea in credit, because in times like this, you see a lot of disparities between like ABS pricing and CMBS pricing and corporates. A lot of the traditional relationships get sort of blown up, and you're starting to see that now, where like AAA ABS backed by credit card receivables are pretty far out of line with where you typically see them trading relative to corporate. So a multi-sector manager can take advantage of some of those dislocations.
Thank you for that. And I think there is a level of unanimity in the answers that we've been able to hear. Plus, there's some perspectives that we've been able to hear. We're almost out of time. I know that we've got some more questions coming in, but in the interest of being able to close things out and maintain time, we will respond to those questions post the webinar by email. And to all of our attendees, if the markets and current conditions are making your head spin and leaving you confused or paralyzed into inaction, call your financial advisor if you have one for a discussion and understanding of the best course of action for you. If you do not have a financial advisor, get in touch with the team and we'll help you find a financial advisor that you can work with. Just drop an email to the team and they will revert right back to you. A big thank you to our panelists, to Atul, Joseph, and Neelam for joining us today and sharing their time, knowledge, and their perspectives with us. It has been an interesting conversation indeed. And also a very big thank you to our attendees. I am not going to thank you for your time, no, but I will say a huge thank you for your attention. It is the Eid weekend that we are heading into, and on behalf of everyone at Continental and our panelists as well, I wish each and every one of you a happy and a blessed Eid. As we exit, we have a short feedback form for you so do fill that in, take a moment and fill it in. It helps us, it gives us it gives us your feedback and helps us put together these events that we hope you enjoy. Have a wonderful rest of your day, and I hope to see you at another one of our webinars. Thank you and good evening.
Thank you.
Thank you. Take
Thank
care.
you. Bye-bye.